When a company's narrative shifts, markets react, often abruptly. For Converge, the pivot from being a high-growth broadband compounder to a maturing telco has erased nearly half its market value in just a year. The de-rating is understandable, yet with the fundamentals at play, the sell-off invites closer scrutiny, perhaps even reconsideration. Look back a few years, and the Converge story was tantalizingly simple. Low fiber broadband penetration in the Philippines, rapid subscriber growth, and a pure-play model unsullied by legacy baggage. The numbers were compelling. In 2025, revenue jumped over 10% to 44.8 billion pesos. EBITDA rose at a similar pace, and net income approached 12 billion pesos. The business boasted a 60% EBITDA margin and an enviable cash generation profile. But by 1Q 2026, the narrative had changed. Revenue growth slowed to 4%. Residential, the heart of Converge, grew just 1%. Net income plateaued. For investors accustomed to double-digit gains, compression replaced collapse as the central concern. Lower ARPU is the culprit. As Converge pushes into broader, lower-income markets with affordable plans, average revenue per user has dropped nearly 7% through 2025. Costs are rising faster than top-line growth. Receivables, particularly in residential, are becoming harder to collect. Capex has doubled, hitting more than 40% of revenue, even as headline growth slows. And while debt has increased, coverage remains robust, with leverage well below regional and historical warning lights. But to focus only on these growing pains is to miss what endures. Converge commands one of the Philippines' most significant fiber infrastructures, over 890,000 kilometers of network, and millions of ports still available. These assets give Converge options: organic subscriber expansion, enterprise connectivity, leasing, and infrastructure monetization. Notably, the enterprise division is accelerating. Enterprise revenue rose over 20% in 2025 and 16% in the first quarter of 2026, even as residential momentum ebbed. New data centers and network investments support this evolution, positioning Converge as more than a consumer broadband provider. It's becoming a true digital infrastructure platform. Risks remain. ARPU must stabilize. Receivables discipline is crucial. Capex intensity must eventually normalize. But the company's strong operating cash flow, above 60% EBITDA margin, ample debt service coverage, and low net leverage all suggest resilience, not decline. The current market price implies Converge's story has ended, leaving no new chapter worth reading. Yet the evidence suggests a transition, albeit a messy one, rather than a terminal decline. For investors willing to look past the headline numbers and monitor key inflection points, ARPU trends, receivables quality, enterprise growth, and especially returns on invested capital, Converge may be more undervalued than broken. This is the hallmark of a maturing compounder, not the flawless ascent of early years, but the steady accumulation of durable value, even as the narrative gets more complicated. The opportunity now is to trade panic for perspective. After all, maturity is a process, not a funeral.